Hi, it's Cam here from My Trading Academy with last week's market wrap. So last week, news was all about the government bonds. It's a fairly complex issue, so I need to explain to you really in simple terms what government bonds mean and how that can affect the economy. So first of all, government bonds. Government bonds are a bit like a fixed term deposit. And just like fixed term deposits, there's different terms. So with government bonds, you've got the larger bonds, which are 30-year bonds. You've got 10-year. You've got the shorter term bonds, which are 2 years and 3 months. So you've got different types of bonds. What we saw in the news was that the 30-year government bond, the actual return on that investment actually dropped very, very low. And what that means is, if the returns are dropping, it just means the demand for the bond is going up. So as bond prices go up, the actual interest rate or the return you get on your money drops. Quite a very conservative or defensive way to invest money. So the big news last week was that with these government bonds is that the yields actually inverted. So what that means is that the shorter term yield is actually higher than the longer term yield. And then what that means to the market is that it's quite a defensive or a negative sign to the market. The last 5 recessions has been caused from an inverted yield curve. And this is what this inverted yield curve looks like. So let's look at the stock market and how it reacted to this news last week of the inverted yield curve. You can see here on the chart, this was the day where the news came out of that inverted yield curve, and you can see we had a big drop on the S&P 500. However, this news was short-lived because Trump came out the day after to buoy up the stock market. He said that he was going to be, the September tariffs were going to be delayed to December, and the market really enjoyed that. So we saw the last 2 days of the week, the market started to run back up. So that's tried to negate the negativity from the recession fears. And then also what came out over the weekend was that China were going to cut their interest rates. When China's cutting the interest rates, that's a very good sign for the economy in terms of they want to stimulate spending and stimulate the consumer activity. So we saw the market start to rally a little bit from those recession fears that we had midway through the week. So as you can see from the chart, we had a very volatile week. However, the market did finish in that midpoint of that range, around the 50% of the high and the low. The market still hasn't set a trend in which way it wants to go. It does seem like the market is very reactive to news at the moment. So if you're trading these markets, it's very good to be in and out of the market, short-term type trading, and just follow the news announcements. That seems to be the best way to go right now. So if you want to keep up to date with the latest news announcements and find out how these news announcements can affect the markets, then follow us for more.